Tuesday, January 28th, 2020, Maneco 64, home of alternative economics and contrarian views. Before I start this morning, I'd like to thank my viewers, subscribers for their support. The channel is becoming more and more of a community. If you want to support the channel through PayPal, Patreon, through buying products like End of Fed mugs, you can go to the Teespring store below, Maneco 64 Teespring store. There are other merchandise there as well. I'd like to thank everyone for their support. It helps. So today I want to talk about inflation, the inflation deception, so to speak, the definition of inflation. And I've spoken about this many times before. I've got some anecdotal evidence I wanted to talk about as well, about how prices are rising, but they're keeping it like under wraps. Not only the government, but companies, restaurants. Yes, you've all heard of shrinkflation, right? But before that, let's look at the markets first this morning. See what they're doing. Yesterday, of course, was a big down move for the stock market. The Dow dropped 454 points, or just over 1.5%. Some people thought it was a huge crash, 450 points. Well, it seems like it, but with the Dow almost at 30,000, it's not even 2%. I remember the day when you did have regularly 2% corrections. If we had one today, of course, it would be almost 600 points or so. So it's quite scary the way the markets have moved in the last few years. There's been very little corrections. I saw one of the Wall Street economists or analysts, not sure if it was a hedge fund one or a bank one, I think it was Morgan Stanley. They said, yeah, the market is going to correct, but the Fed is not going to let it correct more than 5%. So that's the way things are at the moment in the markets. So let's have a look at what we're doing this morning. It's 8:23 a.m. London time. We've got spot gold down here just under $4 at 15.78. Range has been 15.83 to 15.76. So gold's still doing quite well. Despite the fact that we're up quite a bit in the stock market, and I'll come to that in a second. Silver, really frustrating still. We're actually testing $18 here. Yesterday, it traded up to almost $18.50, and then it just came off. Some people will argue that silver is a mixed commodity, industrial and monetary. So yesterday we had huge drops in the stock market in commodities like oil. So maybe that's the excuse for silver not going up. I'm not too convinced. I still think that silver is very important in terms of money. Well, look at all the countries in the world where the word silver means money, like in France, argent, or in Spanish, plata. So there is, I think, a concerted effort to keep silver under control, because once silver starts going up, gold is very difficult to control. Anyway, the Dow future right now is up 150 at 28,675. It has been up as much as 200 points overnight. S&P is up 0.5% as well, 32.58. NASDAQ 100 future is up 2/3% at 9,013. So stock market is rebounding. Haven't really looked into the coronavirus any further. I'll just stick to the market at the moment. I'm sure you can get a lot of news elsewhere from this and much more detailed. But one of the viewers asked, why should it impact the stock markets, this coronavirus? Well, if it gets worse and we're seeing China come to a grinding halt, China is the second biggest economy in the world. That will stop consumers from buying that will affect corporate earnings, that will affect stock prices, and it could reverberate throughout the world. And also, if the virus spreads worldwide, it could have a big impact. It's still early days. Let's hope nothing comes out of this, of course. So the foreign exchange market, we got sterling testing the 130 level. We're down 1/3% at 130.10. Euro is fairly steady at 110.15, unchanged. Dollar up slightly against the Japanese yen, 0.1%, right at 109. And the Chinese yuan has suffered in the last few days because of this outbreak in China. Yesterday I noticed the dollar traded up to just below 7 at 6.99. Same thing today. Right now the dollar is down 0.2%. It looks like, just looking at the markets, that things haven't gotten worse in terms of this virus, even though I haven't looked at the news. Yeah, we're at 6.97. Crude oil is continuing to go lower here. WTI is down 1/4% at 53.01. Brent down 0.5% at 58.38. The bond market, I spoke about the bond market yesterday, of course, about the yield curve starting to re-invert again, and that it was inverted from the Fed funds to the 5-year. Well, right now the 7-year is inverted as well. We dropped quite a bit yields yesterday, so bonds went up. The 7-year right now is at 153, and the Fed funds is at 155. The 10-year as well is getting very close to that 155. We're now at 160. So bond market continuing to show signs of a slowdown in the economy, signs that the Fed might have to start cutting again. I don't think they're gonna do it this week. Maybe in March, or they might point out to cuts in the future. They might give what they call forward guidance. So inflation, yeah, I have spoken many times in the past about how the definition of words is really important. And if you look at Latin, for example, which is a dead language, which was taught regularly in schools up until probably the 60s, or maybe before in some countries, I'm not too sure. It's very difficult to change definitions of words in a dead language, and that was why, one of the reasons Latin was such an important language for professions. But of course they stopped teaching Latin. They changed a lot of the definition of words, and one of them is inflation. I've gone through the little exercise looking at my old pocketbook Merriam-Webster dictionary from the 70s. I'm not going to bring it out today, but basically it says that inflation is the abnormal increase in the supply of money and credit, resulting in a continued rise in price levels. But nowadays you look at any of the definitions of inflation and they basically say it's the result of inflation. And what do I mean by that? Well, they call the measures of prices like CPI, or like the Fed has the PCE, they call that inflation. They don't call the exorbitant increase in the money supply that we've had since '08 inflation. All the QE, all the money printing, they don't call that inflation, and that should be called inflation. Back in the 80s, on Wall Street and the City of London, the most important economic number was M3, which is the one of the money supplies that incorporates cash, deposits, a few others. The Fed used to publish M3, and that was the most important number to look at, because that was real inflation. So if M3 was growing at 5-6%, that wasn't a good sign. But of course, the powers that be weaned the markets, economists off the money supply because they knew they couldn't keep the money supply growing and call it inflation and fool people into thinking there was no inflation. So we don't have M3 published anymore. Even M2, I think they're going to stop. And they've changed the definition. And they do that at schools, at universities. Now, if you look at inflation, they just say, oh, it's the CPI, prices rise. A lot of people think it's because of greedy businessmen. A lot of people think it's because of the weather, because if it doesn't rain and the crops are destroyed, prices of crops go up and inflation goes up. The other old excuse is that oil creates inflation. If the price of oil rises, it creates inflation. But that's all rubbish because inflation is a purely monetary phenomenon. So you increase the money supply. It's the simple law of supply and demand. If you have a mechanism by which you can increase credit, debt and credit, or the money supply willy-nilly like we have had since 1971, yeah, you're going to have massive inflation. So how have they been able to keep these numbers, the resulting rising prices, what they call inflation, low? How have they been able to keep economists, investors from striking, from selling their bonds so they can get more returns? Well, I think the derivatives market, all the leverage, the derivatives market creates false demand for bonds, keeps yields low. I think the fund managers, the economists have a lot to answer for. They're really failing in their duty to protect their clients and pensioners or investors' purchasing power. They're being fooled, and they've had to also invest in securities that are a lot more risky, so they can get more yield in order to provide an income that actually kind of just keeps up with inflation, in my opinion, or the rising cost of living. So yeah, nowadays they call the consequence of inflation inflation. So yeah, what they've done, they've turned the definition of inflation upside down. I guess also the cheap goods from emerging markets, especially China, have helped keep prices at bay of some goods. But the real necessities of life, like tuition, like food, like shelter, rent, they've gone through the roof. The other thing that has kept people going is that, if you remember, probably back in the 50s and 60s, credit wasn't as widespread as it is today. So the way the powers that be get away from the public getting very angry, and I think they're getting angry anyways, but is through credit. People are having to use their credit cards, use all other kinds of credit to keep going because they don't earn enough to keep going without borrowing. So that's how they've gotten away with it. The other day, I went to lunch with my wife to a fairly nice restaurant at a big shopping mall here near where we live. And I've noticed that maybe 15, 20 years ago, if you ordered a main meal, you didn't have to order sides. Everything was included and in the price. Now, if you look at the main meals, like a nice steak, for example, you have to order sides. Like if you want vegetables or French fries or mashed potatoes, it's an extra £3-4. and you're already paying like over 20 pounds for a nice steak. I remember the days when a nice steak was about 12, 15 pounds. I remember the day when starters, if you wanted to have a starter, that was about 5 pounds. Nowadays, the starter costs the same as the main meal used to cost. So, yeah, they get away like that. They're actually making you pay for the sides in the restaurants. If they put it all together and increase the price to like 35 pounds, people would probably stop going to these restaurants. Of course, there are other restaurants that still provide some pretty good value meals, but they are the exception. The quality, of course, is not as great. So, and I don't have to talk about shrinkflation. I remember the packet of minstrels, which is like kind of like an M&M here in the UK. It used to be maybe 50, 65p, maybe 10, 15 years ago, and it was quite big. Now it's like this size, and it's almost a pound. So we know about shrinkflation. We know about hedonics. Basically, let's say a car 20 years ago cost 20,000 pounds. Now it costs 40,000, but the CPI doesn't calculate it as if it doubled. They say it only went up 10% because you've had so much improvement in the car. That's hedonics. The thing they don't, that's a good theory, but in practice, people's salary and wages haven't gone up, haven't doubled. So they still need to buy that car. And how do they get away with it? Well, because people now buy car on finance. I remember in the early mid-90s, it was rare that people bought cars here in the UK on finance. Nowadays, you look at the adverts, it's all on finance. They don't even give you the sticker, the full price. So there you go. The inflation deception. Unfortunately, I think that's fooling a lot of people, and a lot of people are losing out by keeping their wealth in the fiat currencies. And that's why, of course, I always recommend precious metals. I remember buying a gold sovereign for 50 pounds less than 20 years ago. Now it costs about 300 pounds. So there you go. Protect yourself against inflation. Keep stacking gold and silver. If you enjoyed this video, make sure you hit the like button. If you're not subscribed to the channel yet, think about subscribing. Please share this video far and wide. And you can also follow me on Twitter, BitChute, Steemit, and DTube. I wish you all a great day. Take care. Bye.